All right.
Allow you that, so that should allow you to get on now.
Please start this webinar.
Ah, I got 50.
That's our sign.
All right.
50 it is. So we're going to go ahead and get started. So this is our first webcast of 2021. Today's Thursday, February 4th. I'm Eric, and I'm glad to have David, Linda, and Jake with me here today. I want to thank everybody for coming. It's great to see everybody's names for those that have logged in. We've got a great crowd again today. We hope to continue to do this at least quarterly, as often as necessary. And so while we haven't seen a lot of you in person, given everything that's been going on, it's been nice doing the amount of webcasts, Zoominars, even conference calls. And so I appreciate everybody's flexibility, staying in touch with us. It's worked out actually very well. So a couple of housekeeping items. So if you haven't noticed, everyone is muted on this call. So we've got 30 minutes of prepared remarks, and then we're going to open it up to Q&A. We do encourage you to ask questions as we go along. In the Zoom window at the bottom, you can ask questions through the Q&A function. So please load us up. I want to thank those that had sent questions ahead of time. We'll try to get to all of them during our time after our prepared remarks. So the webcast is being recorded and will be posted to our website in the coming days. We'll also make the slides available for anyone that would like them after we're done with the meeting today. So here's a little bit of a short overview of what we're going to cover today. Agenda looks like we're going to talk through the economic recovery that we're currently in, things that cause us caution, things reasons that we're optimistic, and then really with the cause and optimism, what the implications are from an investing and planning standpoint. And then we'll wrap up with a summary. So with that, I'll turn it over to David to kick us off as a summary for the economic recovery. So David.
Great. Thanks, Eric. Appreciate that. If we were having this webinar a year ago, the comment would be, you know, it doesn't get any better than this. The economy's doing well, the stock market's doing well, unemployment's very low. How little did we know how that would be transformed in the next 12 months? And so here's a chart of the S&P 500. And what you saw is the year started out great in 2020. And then, you know, all of a sudden when the virus became not a Chinese problem, but a global pandemic, the market just plummeted because you started to see economies locked down. And in 3 weeks, we dropped 30% with the S&P. I mean, just unprecedented how quickly it went down. Now, the good news is the Federal Reserve, they learned from 2008 and 9, and they immediately stepped in, lowered rates, provided liquidity into the market, started printing money at an unprecedented rate. If you go back to what they had done back in 2008 to 2014 or 15, took 6 years to print about $3 trillion, and they did it in 6 weeks in March and April. The federal government stepped in an remarkably quick turn of events, got together and put out $2.4 trillion in checks to businesses, to individuals. And it was a shotgun approach. And people say, well, not all those businesses should have gotten that money, or individuals that still had a job didn't need the money. They didn't have a chance to target it. They had to get it out, or we would have gone into a depression. I mean, that's the reality. And it wasn't just the federal government here and central banks. It was all over the world. And with the vaccine trials starting and the unprecedented speed at which they did that, the market quickly started to recover. Not on fundamentals, but on liquidity being pushed into the system. And then as we got through the election and the vaccines were approved, then you started to see a steady increase in the market during that time frame. So that's looking at the market and how that occurred. Let's look at the economy of where we are right now. Now, this chart, it goes back 25 years. And above that middle line means there's growth. Below it, it means a decline in growth, and therefore a recession. And what you see is there's only a couple of times during that 25-year time frame where we had any material drop in GDP, which is amazing in itself in 25 years. One was back in 2008 and 9, and then last year. And last year's was worse than we've had in the last 25 years. But what we look at is 2021, if we get sort of opening of the economies around the world by the middle of the year, we're going to have probably 4.5% GDP growth, and globally probably close to 6. We haven't seen that for 20 years. So, even though last year was really bad from a pure GDP number, this year could be really, really good. Now, if we look at unemployment, it's a little bit different story. Because, and let me just explain this chart quickly. The shaded areas are when we're in a recession. So this goes back all the way to year 2000. When we get in a recession, people get laid off, unemployment rate jumps up. And then as we get into the expansion, the recovery, what happens is you start seeing that go down over time, and hopefully it gets down to where it was before the recession. What you saw here is just a meteoric rise in really the second quarter of last year, where we went from 3% to 15%. And now it's come back, and you say, wow, David, it's dropped dramatically. It did in the third quarter. You're seeing that sort of go sideways to a little bit better recently. So it's not going to immediately go back down to that 3%. But that's not all the story. If we look at the next charts, and I love this, the name tag, hello, my name is unemployed. And there's between 8 and 12 million people in the US that are wearing that tag today that weren't a year ago. And that's one of the problems that we see. The unemployment rate that is this headline news that I said was 6.7. The problem with that is the definition of being unemployed. If you get laid off and you're looking for a job, the government says you're unemployed. If you get laid off and you're having to take care of your kids, small children that can't go to school because the school is closed, you're not considered unemployed. Or if you lost your job and you're taking care of a parent that's sick, you're not considered unemployed. So we look at another series. They call it the U6 employment rate, and it's really the underemployment rate. So it takes everybody that is officially unemployed, takes people that are unemployed but not looking for work, and takes people who are working part-time but want full-time employment. And that number is nearly 12%. That needs to come down substantially. The bottom number, the bottom graph there, if we look at that, if you've been with us a while, we've shown you this several times in the past. And all it does is it doesn't really say, are you looking for a job, not looking for a job? It just says, are you employed? And it's a percentage of the population. And before this pandemic came, we were at 61.5%. We're at 57.4. So you got basically about 4% of the population used to have a job, now doesn't. That's bad for the economy. We've got to get that back up. And that is really going to be dependent upon, us getting on the other side of this pandemic, because a lot of those jobs are airline jobs, are travel jobs, are tourism jobs. One of our clients that's in Hawaii, they were talking about 20 some odd % unemployment over there because nearly all of that is tourism, and it's shut down. So we're on the right track, but there's still some caution there. And in talking about that caution, I'll turn it over to Jake, because one of the things that we had talked about before is the light at the end of the tunnel. And, tell us about that, Jake.
Yeah, it's funny. We used this analogy on the last webinar to just help explain that the news of the vaccine was kind of the light at the end of the tunnel, but we're still in the tunnel, right? We kind of joke around internally here, is that really the end of the tunnel, or is it a speeding train with its lights on heading towards us, right? So I'll spend just a few minutes talking about what worries us, what gives us some cause for caution. And the first thing is still the virus. I mean, it's the key source of uncertainty for global economies to, want to reopen. And with 100 million cases worldwide, economic recovery is is directly linked to us having some type of lasting control of this virus. And as we know, all viruses mutate. You know, we've seen a handful of different strains pop up around the world. And the worry is that, do these mutations cause the pandemic to go on longer, or does it, you know, does it cause these newly developed vaccines to really become ineffective or not provide the protection that we hope it will? The good news is the early results suggest that the vaccines are effective against these different mutations, and it may need to be that the vaccines need to be tweaked or re-engineered each year, kind of like the flu vaccine, for them to remain effective. So, but I think the point here is that we definitely need a sustained control of this virus in order for economic recovery to continue. And the impact of these mutations is largely unknown at this point. The other thing that gives us some worry is valuations. And over the past several years, I've had a lot of you ask me, hey, this market looks really overvalued, Jake. And we completely agree. That this chart shows some of the typical metrics or measures for valuations of the S&P 500. If you look on the left side, you know, enterprise value to EBITDA or to sales, market cap to GDP, or the forward price to earnings ratio, even price to book. All of these metrics are at or near the 100th percentile of historic norms. So very rich as it relates to valuations. The chart on the right, though, you know, I think is helpful because these high valuations have historically been sustainable in an environment where you have low inflation, you have low interest rates, or you have high earnings. And that's the environment we're in right now. The one thing that is different compared to these past times, though, is the amount of central bank intervention around the world. So we would say that there are some metrics that show things not being overvalued, but the vast majority of metrics show that the markets are very rich at this point. They're very ripe. So the other thing that gives us concern, and we talked about this a lot in the last webinar, is policy risk. Now, you know, now that we know who we have in office, it's more about, okay, what are some of the potential things that could happen? And the biggest thing that we've highlighted is potential tax increases, and mostly increases in the corporate tax rate, you know, also for personal income taxes and capital gains taxes. So those are the things that we're keeping a close eye on. Doesn't seem like the market's really, you know, done any repricing yet, maybe too soon. We don't really anticipate anything major happening from a tax standpoint early this year. Could be late in the year or early next is kind of our thinking if something happens there. The other one is regulatory changes and that are going to affect businesses or jobs. I mean, a small example of that is the Keystone Pipeline. I mean, Biden's first day in office, he canceled the permits to that, and that affected some jobs. So those are some of the things when we talk about policy risks that we just try to keep an eye on. And there's going to be some things that just aren't on our radar or that are maybe unforeseen, as diligent as we try to be with things. And so maybe as an example to that is, you know, I'm from Utah. We were talking about snow earlier in this call, but we normally get a lot of snow. This year, it seems like we haven't got quite as much, but we also get our fair share of avalanches as well. And the thing about an avalanche, there's usually three key components to an avalanche. You got to have a steep slope, typically. You got to have an unstable cash flow or unstable snow. And usually that's like you getting, you know, a fresh bit of snow on a hard slab of snow below it. And then there's usually a trigger. And you know, that trigger can be natural causes such as, you know, wind or rain or additional snow. But 90% of the time, it's typically a human that causes that trigger, either somebody skiing or snowmobiling or hiking in the backcountry. And the thing that I would say about this is, you know, with markets, we never know what that trigger is going to be for the market to start to decline. But sometimes it's not that the trigger is important. It's just that the trigger is kind of the catalyst that shows that the market's unstable. And so for each current event that happens, we ask ourselves in our investment meetings, you know, could this cause a larger decline? And last week was a great example of that. I mean, GameStop, Robinhood, a Reddit thread, they were in the news a lot, right? Got a lot of attention. We got a lot of questions on what's a short squeeze. And basically there's a large amount of retail investors that piled into some of the most shorted names in the market. GameStop, AMC are a couple examples of that. And you can see what their stocks have done. But this piling into these names caused a massive short squeeze, which created billions of losses for several large hedge funds. And so it got a lot of attention. Now, short squeezes aren't new. They've been around for a long time, but this coordinated effort of a lot of retail investors with this Reddit thread, that's definitely new. And so that was the discussion we had was, could this cause a larger fallout? You know, the good news is we don't short any of these companies. However, the cause for concern for us was, hey, volatility starting to increase. And, you know, could this cause other large hedge funds to have to liquidate some of their positions, which could cause the market to correct a little bit further? So we'll spend a few more minutes in the question and answer because we've had a lot of questions on this. But I think fortunately for you, last week, we were able to take advantage of the volatility a little bit. We took some money off the table. We were able to buy back in a little bit lower. And so it was a small win for us. But I think more importantly, it just is a good reminder for us that we can't become complacent on you know, current issues, whether we're invested in those areas or not, because it could be the next trigger for an avalanche in the market. So so maybe to that, Linda, what do you think? Is this a speeding train?
Well, the light at the end of the tunnel may very well be a train, Jake, but what if we're really finally starting to see some daylight? So we believe that for 2021, we're going to see a continuation of the themes that carried us forward through last year, and that should continue to support markets. So just as David was talking earlier in the opening part of the discussion on the economy, we expect continued low interest rates, continued bond purchases from the Federal Reserve, continued stimulus out of Washington, and obviously a continuation and hopefully an improvement on the vaccination efforts. But the key driver for 2021 comes from two different areas. So let's start with the Federal Reserve. This gentleman is our Federal Reserve Chairman, Jerome Powell. And of course, it's not really a picture of him, and he isn't throwing money at all of us, although it sure seems like we're keeping the printing presses running nonstop. And indeed, the Federal Reserve just reiterated their position to maintain low interest rates for an extended period of time and to continue to back the bond market liquidity. Now, backing the bond market means buying bonds, and that increases their balance sheet when they do that. As we speak, the balance sheet for the Federal Reserve stands at $7.4 trillion. That's up $4 trillion from the start of the pandemic, just a little over a year ago. Also, in their last meeting of the year, the Federal Reserve stated they had revised their inflation goal to an average of 2% before we would likely see any interest rate increases. Now, I just want to point out here that we were not able to get a 2% inflation target for all of going to sound like a broken record, but easy monetary policy being followed by the Federal Reserve remains a key driver for pushing markets higher this year. So as for the rest of the good news, we got to start with, if you go to there we go. It has to start with herd immunity. We said it in the market commentary, both David and Jake have alluded to this in their presentations. Herd immunity gives us the confidence to move forward, which will lead to employment gains as we reopen the economy, which gives more consumer spending power, and that leads to higher corporate profits. So at the top of that list is herd immunity. Let's unpack each one of these just a little bit. So this represents a graph of the United States and where we are at with respect to the immunization schedule. And I'd say, while it is green, it's actually fairly sad. Herd immunity is going to be key to helping us move forward. The approval of Pfizer and the Moderna vaccines in December started us on another path to reaching that herd immunity. The challenges with distributing such a tricky vaccine, however, the need to freeze the vaccine at low temperatures, as well as the fact that we need 2 inoculations in order to get maximum immunity, has proved to be a much larger task than most of our states have been able to manage efficiently. Now, last Friday, Johnson & Johnson and Novavax, 2 other companies in the pharmaceutical space, announced the completion of their phase 3 clinical trials for their vaccines, which looked really good. Should actually move this process along faster. They have applied for approval through the FDA. If we see those start to ship in a couple of 3 weeks, they are a more traditional vaccine delivery, just requiring refrigeration. So that should speed up the process. But make no mistake, in order for us to heal this year, both economically and physically, we have to get to herd immunity in order to instill that confidence in everyone. So what is herd immunity? Well, experts estimate we'll reach herd immunity at 70% of our population. So right now we have vaccinated about 31, just short of 32 million people. We have 26.5 million people who have contracted the virus and should have antibodies to fight off a recurrence. But we still have another 170 million people to go. We're about 20% of the way there. So it's not going to happen in days. It's going to take some time. But as we proceed towards that goal, we'll be able to reopen businesses, especially those most hard hit by the closures during the pandemic. And that should provide some good momentum for those employment gains. So is the consumer ready to take off? Is there pent up demand for more stuff? Well, maybe not toilet paper and Clorox wipes right now, but let me share a story with you about our family. In the early days of the pandemic, of the lockdown, I asked my family, what was the first thing they wanted to do when we reopened the economy? And my husband's answer was sit in a restaurant with a beer and an order of wings. And I asked the question again recently, and the answer had changed just a little bit. Now it was book first class tickets for Europe and stay a month. So I'd have to say that the price of our personal relief package shot up quite a bit. If we're any indication, the confidence that consumers feel once we're at that herd immunity and fully reopened as an economy should unleash some pent-up demand that provides more fuel to both the economy and the stock market. Now, wanting to travel and spend is one thing, but the ability to afford that is another. However, what we see here, this is the US personal savings rate, is that the effect of the pandemic and the lockdown is a little bit unexpected. Between stimulus checks, the limited ability to spend our money, and then a big one, which can't be understated, is the refinancing of mortgages. The American consumer has actually been able to improve their savings rate substantially, and that in turn is going to improve our purchasing capacity. So it's for all these reasons that the forecasts from the major analysts predict a sharp rebound in corporate earnings this year, anticipating 34% in global earnings per share growth. Now, as you see from this graph, each vertical gray bar here is an earnings recession. They tend to coincide with an economic recession for obvious reasons, but the point we want to make here is you will see that some of those deep recessions, such as the dot-com bomb back in 2001, 2002, the financial crisis in 08, 09, obviously we saw a huge drop in earnings, followed by a pretty steep recovery in earnings growth. And that is very consistent, what is being projected for this year, very consistent with what we have seen in earnings recessions in the past. Now, in 2020, the world underwent a sea change. We used to call that a paradigm shift, as businesses shifted from work from home and consumers employed delivery services and bought up entertainment products and services in force. So technology and other growth stocks were clearly the winners last year. You'll have only to look at your portfolios here, and where we have individual stocks, you're going to see technology and biotechnology very well represented. The pandemic forced a form of innovation upon the global economy, and with innovation, we can support higher valuations. But how high? Well, I want to remind everybody that Alan Greenspan, who was our Federal Reserve Chairman back during the dot-com era, had pointed out the fact that technology stocks were getting very bubbly, very overvalued. The problem is that he pointed that out in 1996. And that was a good 3 or 4 years before we started to see that market deteriorate. So bubbles can last a lot longer than we think they should be able to. So David, with all of that as a backdrop, you want to give us some idea about the investing and financial planning implications for what we're seeing.
Yeah, absolutely. So when we look at all of this, potentially higher taxes from a policy standpoint, and we don't know how that's going to shake out, if it impacts capital gains, whether it impacts estate tax planning. But the tax planning piece, we will be very vigilant in looking at that, because if tax rates go up, there are some things that we can probably do. Roth conversions that we've talked to some of you, a lot of you about in the last few years. Even if the Biden administration doesn't change the tax rates at all, in 2026, they're going to go up because they revert back to where they were in 2016. So Roth conversions can, depending upon your tax situation, those may be more important going forward. If tax rates go up, munis become more important. We're using high yield munis in some of the total return income strategies, and that may increase if those tax rates go higher. And then one of the things that you're seeing is we're starting to put some small cap and international in the portfolios when we really haven't had hardly any of that for the last decade, because the last decade you wanted to be US large cap stocks. And if you were anything else, you didn't do as well. We may be seeing some of that change, but really won't know on some of that until we get to the herd immunity around the world. And on the estate planning, if right now a couple can have $23 million in their estate and not pay any estate tax, there are people talking that might go back to $3.5 million per person. Well, all of a sudden, some of you guys that looked and said, 23 million, I don't have to worry about it, may look and say 3.5 million, I do. So there are some changes there that may occur, but we don't know. And as I think Jake pointed out, you look at it, it's probably mid-year or to the end of the year before we get these occurring, because I don't think President Biden will want to do this until he sees we're getting out of the pandemic, because probably not a smart thing to do. So those are things that we're looking at from a planning standpoint. Now, as we look at the market, Jake pointed out some things that make us cautious. Linda pointed out some things that make us bullish. And it's really this weighing what one is versus the other. And on the one side, you look and you say, we've got the virus mutations, we got valuations that are sky high, we got policy risks, and other things, short squeezes and implications of those types of activity that might cause an avalanche in the stock market. And then on the other side, you've got the Fed printing an unfathomable amount of money, $120 billion every month. I mean, billions don't even mean anything anymore, it seems like, at that level. The herd immunity as we're getting back, and the pent-up demand on it, and the low interest rate. I mean, Linda talked about that, of refinancing mortgages. Somebody that refinances a mortgage that was at 4% and now is at 2.5%, they've got thousands of dollars a year, not just this year, not like a stimulus payment. They've got that for 15 to 30 years. So there's a lot of those things. And I don't mean to say, here's one and here's other. I remember, and I think it was Ronald Reagan made the comment, as he said, what I want is an economist that only has one hand. So you can't say on one hand this and one hand that. He said, I just want one that only has one hand. We're not trying to say that, because overall, when we look at it, we look and we are optimistic. We will get through this. The timing is what is suspect a little bit. And one of the great quotes that I've remembered for years, Sir John Templeton, he started the Templeton mutual funds very successful mutual fund group, really smart manager. And his comment of the definition of bull markets are born on pessimism, grow on skepticism, mature on optimism, and die on euphoria. Well, in the middle of March, we were clearly pessimism. During the summer, probably skepticism. Today, I don't think you say we're pessimistic when things are at all-time highs. The question is, are we in optimism or are we in euphoria? And as Alan Greenspan, Linda pointed out on Alan Greenspan, you can see that it looks like one, but it may take a while before we get that. We clearly went through pessimism and skepticism very quickly, but we are positive. And there are some great things that are starting to occur. When you look, and I'll sort of go off script, and Eric and Linda and Jake can say, he's going to talk more. But a quick thing here, if you look at like artificial intelligence, that is the crux of, and I'll just use one example of automated cars. And you think, well, yeah, that'd be kind of nice. Look at the implication of if we have cars that drive themselves. Will you have as many wrecks? No, you won't. Will you have as many people die in car accidents? My dad was killed when I was 14 in a car accident. You look at those things that won't occur, and then you look at changes in industries and how that will happen. If you're in an automated car and there's an accident, are they gonna sue you? Or does that lawsuit go against the software providers on the automated car? I mean, there's a whole lot of things that we're going to see, that new technology, the 5G that's being rolled out, that will start complete new industries and change the way we look. So we think there's a lot of opportunities, and it's looking and saying, what's going to work? Where do we need to go? But we know there's a lot of risk out there. And just like last year, if risk starts going up, we start pulling some risk off the table, because, in this day and age, things are sped up quickly. And, as we saw in March, if you say, well, let me wait a few more weeks, it can be too late. So anyway, Eric, I'll turn it back over to you, but we are optimistic. We will get through this. But there may be some avalanches during that time frame, and that's what we try to do, manage those things.
Yeah, so I want to thank everybody for all their questions that have been queuing up during this presentation. Like I said, we got a few before the presentation as well. The one, if I can kind of distill some of the common questions, come down to the one word is inflation. Why haven't we seen inflation? Everybody talks about inflation. We've been talking about inflation. Whether it's the government that is printing the money, whether it's the stimulus checks that are going out, it's this ongoing question about when and what does that look like?
Well, I'll jump in on this. I know that everybody's surprised that I would jump in on this, but we are having inflation. We have for a decade. It's just not the traditional inflation that you think about. So in the 70s, 60s and 70s and early 80s, when we had at one point double-digit inflation, it was at that point, there was more money flowing to workers and consumers, and they were taking that money and they were buying stuff. And so there were more dollars that were buying the same amount of products. It goes up as inflation. What we've seen, the printing of money by, as Linda talked about and I talked about, they've added $6 trillion in the last 12 years out of thin air, printed it out of thin air. And people say, well, I don't see inflation. All you have to do is look at the stock market. You look at the valuations that Jake's talking about, risk assets, real estate, bonds, those types of things, stock market, those have gone up. It's been inflated because that's where the money's flowing to. When the Fed prints money, they're not sending out to individuals. Now, it does come into individuals, some in lower interest rates. It's going to be interesting to see, because now when the federal government is writing checks to individuals, whether that then starts to increase on the inflation side. And I will caution you, one of the data points that people are pointing to, and erroneously, they're saying, well, look, all you have to do is look at the labor costs. They're going up. That's not true if you look at what's happened. What's happened is people that are working in restaurants, people that are working in hotels, people that are working, on airlines, that have been laid off. A lot of those people are in lower paying jobs. So if you lop off 4% of lower paying jobs, the average wage of the rest of the people by definition goes up, even though nobody is getting paid any different than they were before. So, but it will be interesting to see if you start seeing this consumer inflation because the checks that everybody gets. And so.
Yeah, I think the other question that is somewhat related to the consternation on when are we going to get inflation is the challenge that we all have when we look at, well, what about the national debt? We talk debt to GDP seems way out of control. The deficits seem way out of control, right? You rewind even a decade, definitely 20, 30 years ago, if you were to go back in time and tell one of the presidents or somebody in Congress that we would have this, it would completely blow their mind that you would, again, think that we would have just rampant inflation and there's no way we could function. Yet we've been spending and printing money for well over a decade now with really what we would think is no implications. And so how much farther can this go?
Yeah, and that's the tough one, and it may be like the old saying of how did he go bankrupt? Well, slowly and then very quickly. This may be that we get for a while, but one of the other offsets of this, if the Federal Reserve was the only central bank around the world that was printing money, I think it'd be a completely different scenario. But Bank of Japan, Bank of England, European Central Bank, Bank of China, Bank of Canada, Bank of Australia. I mean, all of those are printing. And so I think part of it is if everybody's printing, it goes up, but you don't notice it. I mean, if you were out in the bay in a little boat and you just sat there for hours and hours, you wouldn't realize that the tide came in or went out because it seems like everything's the same. I
think too, I think the other part too, it's all relative. We get concerned about our debt to GDP and what we're used to, but there are developed nations that we can look at and be able to say, yeah, but ours is still way better than theirs.
Yeah. You're exactly right.
Even though from a dollar amount standpoint, it may look different, but from a ratio, we're still better off than a lot of other developed nations.
Yeah, I mean, Japan's the poster child of this. We would have to print probably 3 or 4 times what we have to be where they are relative to GDP. But you can also look, you look at Japan. They've got a shrinking, population, and for the last basically 32 years, that they just go through anemic growth and recessions. And perfect example, the Nikkei in 1989 was 38,000. Today, that's their equivalent of their S&P. Today, it's 28,000. Think about if 32 years ago, our stock market today was less than it was 32 years ago, it'd be a disaster. And so the implication may be a lot of debt, and what it does is it causes slow growth going forward. That may be the issue, not so much inflation, but we'll have to see. But it is a conundrum because, but same thing. I mean, why should Italy be able to borrow money at a negative rate? I mean, it's insane. But we have the market, and this is where we talk about in our investment discussions all the time. You have to trade the market you have, not the way the market you think you should have, how it ought to be, how it should be, how you want it to be. It's the market we have. And right now, that market is pointing higher. And when it stops pointing higher, that's when we start taking, some risk off and looking at other areas.
So another question kind of around that same topic, and maybe Linda, you can answer this because I know we were talking about it the other day. We've started to see changes in our portfolios, how we've invested, right? So we've had a long time where it's been U.S. large cap, that if you weren't in U.S. large cap, you were underperforming, your portfolio wasn't doing well. So thoughts on how investments in real estate, precious metals, international? Do we see that changing? So that's a couple of the questions that we're getting.
That's, I think, a pretty multifaceted, many answer question. So on the one hand, we are definitely seeing a rotation out of just the US large cap growth stocks. I still think growth has a good story this year, but certainly there's some opportunity for other areas of the market, whether it's small company stocks, mid-sized stocks, international stocks, an opportunity for them to catch up. And the story for potentially real estate, precious metals, and international comes from a weaker dollar. The one thing that does traditionally happen is when you print a lot of money, the world does not reward you for bad financial policies. The world tends to punish you with a lower currency. But as David pointed out earlier, we're not the only one misbehaving in that regard right now. So we're not seeing dramatic shifts in the dollar, but if we see the dollar start to decline dramatically, that should definitely provide some lift for precious metals, real estate, and international stocks as well. It's monitor and revise as our models show us what's trending better.
So David, I'll ask this question not only as part of the panel, but as the compliance officer. So you talk about us being optimistic with what's going on. Kind of one of the questions is more around, so where do we think the market's going to end? We always talk about not having a crystal ball, but so are we saying that we think the market's going to go up for the rest of the year? Just kind of put a little bit of understanding around that.
Well, and I think looking back last year tells you a lot, because if you look and said, by the end of the year, what did the fundamentals tell us? It told us last year was terrible. We had unemployment that jumped. We had GDP that was negative. We had negative growth in earnings for the S&P, and yet we were at all-time high. Why? Well, part of it was, you push a bunch of money into the system and it pushes markets up, but also the markets are forward-looking. And so this is where, and you're exactly right of looking. We don't have a crystal ball, and I can have a scenario, very plausible scenario, where all the good things that Linda talked about happen, all the bad things that Jake talked about don't happen, and at the end of the year, the market is flat to negative. Why? Because all of the good news may be baked in to these all-time highs, and you have to recognize that. And because I've seen people say, well, and you see it all the time, where somebody's earnings will come out and they'll beat the expectations, and they say, hey, it did better, and it sells off. Why? Because that was already baked into the stock price, and the stock market is just a conglomeration, aggregation of all these individual companies. And so we could get to the end of the year and not have a great year or even a negative year simply because it's already baked in. But what we're seeing right now is the trajectory still is positive, but that may roll over. I mean, it absolutely could.
So where do we see most of the GDP growth coming from, right? So the chart where we had, how bad the GDP was last year and the rebound that we see, we're not seeing that come from across the spectrum. And somewhat related to that, where do we see the GDP? There's a lot of discussion about this K-shaped recovery, right? Prior to this downturn, it was always, is this going to be a V-shaped recovery? It is a U-shaped recovery. I think the notion of a K-shaped recovery really got a lot of airtime during this, all of 2020, and just our thoughts on that as well.
Well, I think most of the GDP increase is going to come in services because they were what was hurt the most. In fact, just this morning, that they came out with the manufacturing data for December. It is now at or exceeding where it was a year ago. So manufacturing is completely recovered. If you look at services, it hasn't. And why is that? Because I can go on Amazon and I can buy whatever I want, but I can't, I may not feel comfortable going out to the restaurant or hopping on, a plane and going and staying at a hotel and renting a car. So the services area is what will probably rebound. But then and as I talked about, there's changes. all these companies that had everybody working remotely, some of them have figured out, well, I don't need to fly everybody in for that quarterly meeting. We did just fine on Zoom. So I'm going to fly everybody into our headquarters once a year, not 4 times a year. That changes. I mean, I would hate to own a levered, a building in downtown New York City with a big mortgage on it, because my rental rates are probably going to plummet. And you see, I hear clients or investors that say, look, these REITs are great. You're getting a good yield and they're 90% or 95% occupied. Yeah. But go to the building. That building has a lease and it's being paid because it's, leased by Microsoft. But when that lease comes up in 3 years, they're not going to renew it because a third of their people are going to be working remotely. There's some real changes going on. So it's going to be interesting. We live in interesting times for sure.
Yeah, I've also heard a lot of companies that they're not in their own building, but they've gone and subleased it out just to get people in there to kind of cover the cost a little bit. So
yeah, no, absolutely. I mean, there's going to be some changes, and who knows what it looks like. In fact, I think it was in the last month, Wells Fargo came out, said in the next 5 years they will reduce their footprint in real estate by 20%. I mean, you look at Wells Fargo, the amount of space all over the U.S., and yet I play tennis with a guy that has industrial space, warehouses. And he said, I can't build enough. He said, I used to, I would find a tenant, I would build it. He said, now I just build because people come looking at, for more space. So, I would hate to have downtown office space. I wouldn't be real happy if I had, a mall or a strip shopping center, because those are going to have to be repurposed. And if I have a warehouse, I'm a happy camper. I'm just going to make more and more money.
Hey, Eric, one of the things we ought to touch on is going back to the GameStop discussion. We mentioned we've had several clients this week ask about that. And part of the discussion we had was around, what's a short squeeze and why this occurred. And so Dave, why don't you touch on that just a little bit?
All right. I mean, the crux of a short squeeze is I think a stock's going to go down and I borrow it from another investor, sell it, and I agree that I will replace that stock sometime in the future. And it's at $10 and I hope it goes to $5. I buy the stock at $5. I made the $5. Well, when you have a lot of people doing that, then if the stock goes up, because I buy it at $10, I can only make $10, because if it goes to 0, I buy it back at 0 and I give the stock and I make $10. If it goes to 100, I can lose that 90. Or if it goes to 1,000, it's basically unlimited risk on the upside. So when it starts going up, I look and say, oh crap, I thought I could make 10. I've already lost 30 and I'm forced to buy it back to limit my risk. The problem is, if you got a short squeeze like that in a stock like GameStop, their strategic plan for this year was to close 1,000 stores. I mean, that's not a great thing. It had been trading in $5 to $10, and it's probably not worth $5 to $10. And when it goes to $500, if you think it's going to stay there, you got to think there's a lot of other schmucks that are going to bring in money, because it's not on, if everybody just holds, you've got to have more money to keep it at an elevated price, because somebody's going to look and say, this ain't worth 500. I paid 50, get me out. You've got to have more people coming in. And so unless you have unlimited capital, which the Reddit group does not, I mean, you've got millions of small investors, but they've got most of those people don't have a lot of capital. And so when it starts going down, and a lot of them are playing it like it's a game. And I think if we wouldn't have had the pandemic, so they're sitting home bored, they would be out playing basketball or at the football game or whatever. They don't. So let me find another game, and they're playing there. The problem is, it will cost them a lot of money.
And that's questions that we've gotten and we've discussed, and I don't think we know the answer to, right? When you talk about, is this kind of volatility, is this kind of new trading here to stay? And David, to your point, we had kind of a confluence of events where you had the pandemic, you have all of a sudden zero commission trading ability. You have really access to platforms, whether it's Robinhood or really any custodian on your phone that you could trade. Do we see, and as we've seen over the last couple of weeks, way more attention to the ability to make money? Do we see more volatility, right? I think that's one of the slides that we considered putting in this deck that we scrapped was, the amount of volatility that we see, not only the steep decline because of the pandemic, but that V recovery out. And does that really set us up for more economic instability long term? When you look at those types, you'd have to get used to a 30% decline and a 30% recovery, where we used to say, well, maybe 10% once a year was normal. 20% every 5 to 10 years was normal. Do we start to see that more often? I think that's yet to be seen.
Yeah, and I doubt that is a material change. I mean, if you look at the cycles, look back to the late 90s, the tech bubble, where people were stopped, they were quitting their job to day trade NASDAQ stocks. They didn't need that. NASDAQ was going up 30 some odd % a year. Just put your money in the triple Qs and you still made a lot of money. But they thought, I'm making this money. Then if you remember, probably 10 or 15 years ago, everybody started playing poker. Online poker. You would look at the Travel Channel. It was about poker. You look at ESPN. They had poker tournaments on because people, I can make a lot of money doing poker. No, you can't. You may do a few, but then you won't. And then in lots in Arizona, especially in 2004 to 2007, I'm quitting my job because I am going to flip houses. I can make a fortune flipping houses. You didn't need to flip the house. Houses were going up 20, 30%. You buy it, you put 20% down, a year and a half later, you doubled your money. Keep your job. But they did that. What happened? It always ends in tears. If they think that there's a way to make money with no risk, and I can make lots of it because I'm really, really smart, usually it ends in tears. And the Reddit type thing will absolutely end in tears. Most of those people will lose most of their money.
And I think on top of not only losing the money, I think there's probably some regulatory impact that occurs, right? Yep. So you have different regulatory bodies, whether it's FINRA, the SEC. I think Janet Yellen's meeting with some of the regulators even today as we speak to just kind of discuss some of the broader issues. And so I think to ensure kind of some stability going forward, I think there's going to be some impact. I'm not sure you're going to be able to find the username off of the Reddit and be able to put him in jail or whatever you think should have happened to him. But I think, the regulators will continue to put some constraints to control the market so it doesn't get completely out of hand. Yeah.
And usually the solution is worse than the problem. I mean, it'll just cause other problems. And, it goes back to a fool and his money are soon parted. A lot of these people have no idea how to invest and what to look for. They just heard it. They saw it going up. I'm going to make a ton of money. And, there's no free lunch ultimately. I mean, there'll be a few people who'll make, I put in 10,000, I got out with 400,000, but the vast majority, I put in 10,000 and I lost it all. So.
One of the last questions, we're getting towards the top of the hour. I want to kind of wrap it up with one of the last questions and then we'll close out. So again, it kind of goes back to the notion of inflation, but it's really about what occurred in Georgia with the both Senate seats going to the Democrats. We have a 50-50 Senate with the vice president being the tying run. Really, what are the implications on now that the Democrats could have the checkbook? Are they going to start printing and spending money? And when will we get inflation? I think the shorter answer to that is we've been printing and spending money for the last decade, regardless of who's been in power. And we talked when we did our webcast prior to the election, post-election, is that the market doesn't care whether it's a Republican in the presidency or a Democrat in the presidency. There's longer cycles to that. And one of the things that we start to see is, if you remember long ago when we had a Republican in the presidency, there's always moderate Republicans that would come out and try to take their share of the limelight, whether that's Susan Collins, Mitt Romney, Lisa Murkowski, right? You had a lot of people who were always kind of playing because they came from states that were a little bit of purple and they needed to play both sides of the fence. We've already seen that on the Democratic side. So Kristen Sinema from Arizona, John Tester out of Montana, that they already said they were going to side with the Republicans and not get rid of the filibuster. And so you have people in both parties that'll raise their head, that'll play the middle. And so I don't think that just because we have a 50-50 Senate that all of a sudden everything is going to go by the wayside and whatever the Democrats want to do. And so that's something we're going to watch and continue to monitor. And I'll close with that is that, you know, we continue to read and assess all the proposed legislation that's out there, whether it's tax or otherwise. As David and the rest of us say, we don't have a crystal ball. And even though there's a lot on the table, we continue to review all your investments with you, your tax planning, your estate planning. And once those changes really start to come to fruition, that's where we get back together with you, make sure the plan that we've had in place is still functional and we make changes as we go. This is a hopefully lifelong relationship that you've had with us in Copperwynd, and we continue to react and plan for those things in the future. And so, you know, with that, as you're concerned about things, Jake touched on it. I know we all talk to you a lot about whether you should be tax planning, Roth conversions, what your estate plan looks like. We still continue to do that with this change of administration and see what that looks like. So with that, one more house cleaning. So there's going to be a short survey after you log off this call. We appreciate you taking a few minutes. I think there's only 2 or 3 questions. Just give us some feedback, help us improve these webcasts. So at this time, we're planning on having our next webcast sometime early May, unless something happens before then. But we look forward to talking with all of you between now and then. And thank you for coming today.
Thanks, guys.
Thanks.